Hello and welcome to Startup Street. I'm Arundhati Ramnan and as always with me is Shruti Mishra.
That's right, Arundhati. It's 5 years for Startup Street and we have a fresh new look. We will continue to bring you all the action from the startup world.
Absolutely, Shruti. So let's do that and take a look at the top headlines from the startup world today. The board of Zomato is set to meet tomorrow to consider an 8,500 crore rupee fundraise. Company also plans to approach RBI to restrict foreign holding to 49%. Zomato founder Dwindle launches a new health tech venture in his personal capacity.
Phonepay turns positive on an adjusted PAT level in FY24, reports over 190 crore rupees profit last fiscal. Losses trimmed to about 1,200 crore rupees and revenue comes in at over 5,700 crore rupees. However, the fintech has cut customer support staff by 60% in the past 5 years.
Stockbroking firm Grow doubles its FY24 revenue to 3,145 crore rupees at a consolidated level. Operational profit rises 17% to 535 crore rupees. However, the company reports a net loss of 800 crore rupees due to a one-time domicile tax of 1,340 crore rupees.
Seed stage focused VC firm Titan Capital marks the final close of its new opportunities fund at 333 crore rupees. Titan Capital Winners Fund will invest in follow-on rounds of nearly 20 startups in its portfolio at an average check size of 15 crore rupees.
Dairy tech startup Stellapps secures $26 million in a Series C funding round. This round is a mix of equity and debt to accelerate its Moo-Mark business. Company focuses on contract manufacturing and private label dairy business of high-quality value-added dairy products. Those were the headlines that we're tracking for you this evening, but our top story today, PhonePay has released its detailed financials for FY24, outlining that its net loss has fallen by 29% to 1,996 crore rupees during the year, with revenues increasing by 86% for the same period. My colleague Aishwarya Anand is joining us to give us an overview of the numbers and to shed light on how the firm has leveraged AI to drive a 40-fold transaction surge. Aishwarya, over to you.
Fintech major PhonePay has released its inaugural annual report, revealing a path to profitability driven by automation, efficiency and strategic financial management. To break the numbers down, in FY24, PhonePay has earned rupees 5,725 crore in revenue from operations, which was up 85.5% from rupees 3,085 crores it clocked in FY23. Now, about 10% of this revenue comes from digital payment subsidies from the government. PhonePay's expenses grew 31.3% on a year-on-year basis from rupees 5,907 crores in FY23 to rupees 7,756 crores in FY24. Now, the company has also sharply reduced its cashbacks and incentives between 2019 and 2024. In FY19, it earmarked over rupees 950 crore as rewards for customers to use the platform. It came down to just over rupees 15 crores in FY24. This has also helped PhonePay trim its losses to rupees 1,996 crores in FY24 from a loss of rupees 2,792 crores it posted in FY23. The fintech major said that it has hit adjusted PAT positive, excluding ESOP costs, of 197 crores for FY24, a significant turnaround from the rupees 738 crore loss it reported in FY23. Having said that, building an AI-led customer experience has meant that PhonePay has had to reduce its customer support staff by 60% over the last 5 years, shrinking from approximately 1,100 agents to just over 400 in the age of AI. During the same period, the fintech giant has reported a 40-fold increase in transactions. The company processed 7.22 billion transactions in September with a 48% market share in the payment space.
Thank you, Aishwarya, for those details. Appreciate you joining us. Moving on, after reports emerged of Zomato co-founder Dwindle incubating a new venture, Zomato clarified his involvement in a wellness venture called Continue. In a post on social media platform X, Goyal also clarified that Continue is, as of now, his personal health and wellness team, entirely funded by him. Shilpa Ranipeta is here with the details. Shilpa.
Well, Zomato co-founder Dipinder Goyal's new entity is a health and wellness entity called Continue and is likely to be a health tracker. Now, this was incorporated in April 2023 as Upscale Advisors Private Limited. Now, in a social media platform X, Dipinder Goyal clarified that this is currently for his own personal health. Now, on MCA, it lists Dipinder Goyal as the director and 2 employees of Zomato as additional directors. Now, Goyal said that this is entirely funded by him, and as of now, it is his personal health and wellness team that is tracking and researching his health. Now, through this process, Goyal says they have found several new insights, they're developing new things, and are hoping to gather more before they can share it with the world. But what exactly are these insights and evidence? That is something that we do not know yet. Zomato also, on its part, has clarified that this has nothing to do with the company. It said in a statement that it is not venturing into any new space and continues to focus on its 4 businesses. Back to you.
Right, Shilpa, many thanks for those details. But moving on what's brewing today, dairy tech firm Stellapps Technologies has raised $26 million in its Series C funding round. The round included both equity and debt financing and saw contributions from existing investors like Bloom Ventures, Omnivore, and the Bill and Melinda Gates Foundation, as well as new investor Mile Deep Capital. Now, the U.S. International Development Finance Corporation provided the debt part of the funding. Joining me now to discuss this further is Ranjit Mukundan, the CEO of Stellapps. Ranjit, thank you so much for taking time out and being here with us on Startup Street. You know, before we get into the fundraise and all of that, you started off as a dairy IoT solutions player, and over the years, you've established yourself as a player in contract manufacturing and private labeling of value-added dairy products. So what has this journey been like? And if you could explain to us the need for this pivot.
Yeah, thank you, Shruti. Thank you, Arundhati, for having me here. So as you rightly said, we started off as a dairy digitization company, and started about 14 years ago. And over time, we figured that until you are a full stack, you have a full stack offering, you can't provide enough value to our customers. In the Indian context, doing just technology for dairy operators, we figured the hard way that alone will not help us scale. And as a result, over time, we made some tweaks to our business model. And today, as we speak, we are more of a traceable, digital P2P dairy, helping FMCG companies and direct-to-consumer companies, or D2C as they call it, helping D2C companies launch their own private label dairy products like paneer, dahi, curd, yogurt, and all of that. That's how we have sort of made this work over the last few years.
So it was like an organic way to sort of grow your business as well. But, if we can come to what you do, right? Can you simplify for us what does Stellapps do? And, who is your client, both, Indian and global?
Yeah, say if you're an FMCG company, like an ITC or a Unilever, and you'd like to launch a traceable, high-quality paneer in your own brand, we'll help you private label it completely end to end. Right from sourcing the milk digitally from all these smallholder farmers, cold chaining it, converting it into high quality traceable products so that consumers really love it, so that you can private label and sell it. So if you're an ITC or a Unilever or in the future in a D2C company like a Zepto or a Zomato who would like to private label high quality dairy products, we become the one-stop shop to help them do that.
Absolutely. So that, you've simplified exactly what your business does. So now we can get to the fundraise. You've raised this $26 million to sort of, accelerate the business, especially the Moomark part of it, right? So if you could take us through how you plan to use these funds, what's on offer, you've detailed what's on offer, and where do you see it in the next 2 to 3 years going forward?
Yeah, so we plan to expand our VADP manufacturing components. We plan to invest in additional processing capacity across India. We already have some capacity in Bangalore and in UP, but the idea is to take it pan-India so that if you are an Amazon Fresh or a Zomato would like to launch pan-India, we'll have our services already well established. So the idea is to use this money to expand our processing footprint, expand our procurement footprint, and ensure that we become a truly pan-India player, powering the FMCG customers pan-India, not just in 1 or 2 cities. That's essentially what we are planning to use this capital for.
Right, so big expansion plans there. But you know, your dairy tech is currently deployed in over 42,000 villages, enabling the movement of more than 14 million liters of milk every day, right? So if you could talk to us about your tech edge and how is it possible for you to make this business also global at this point?
Yeah, so as I said, since our DNA was always technology, we were incubated at IIT Madras. We focused on developing technology to begin with. And as you said, today we digitize over 14 million liters of milk flow across India. We are present in over 42,000 villages. And we do continue to sell this licenses technology to other B2C dairy operators. So if you're an Amul or a Mother Dairy or a Heritage or any other dairy operator, you could license our technology and help solve for three things: productivity, quality, and traceability. Because all the three is a challenge in India today because it's a highly fragmented supply chain. Smallholder farmers, the milk moves a long distance from the remote villages to a cup of tea, coffee, or paneer on your plate. And hence, across the chain, as it traverses, how do you ensure that it is residue-free? People are not gaming the system. The cold chains are not broken because it's a highly perishable commodity. And how do you ensure all of that? So we ensure that using our tech, a dairy operator can solve for productivity, quality, and traceability. Now we're also looking at replicating this in outside India. We're talking to, let's say, Danone in Morocco, who would like to deploy this tech in Morocco. We're talking to a bunch of people in Brazil. We're talking to a bunch of folks in Europe to see if this can be scaled in. This tech can be scaled outside India as well.
Right. So big plans to go global there as well, and you're in talks to do this. But if you could quickly tell me in 10 seconds, in FY23, you saw 305 crore rupees in revenue and faced a loss of nearly 32 crore rupees. Where do you hope to end this year, and how do you hope to turn a profit, and by when?
Yeah, so our total revenue was about 360 crores in FY24. This year will fundamentally, FY25 will be more or less flattish. So we'll end the year at maybe 350, 400 crores, so fairly flattish, because the focus has been on expanding the margins, stabilizing the margins. And we hope to sort of break even as a company around September 2025. So that's the target we're working on right now.
All right, break even by September 2025. All right, Ranjit, thank you so much for joining us on the show, and we wish you all the best on this journey going forward.
Thank you so much for having me. Thank you. Thank you.
All right, moving on the hot seat today, we have Primus Senior Living that has raised $20 million in a seed funding round led by General Catalyst with participation from Nikhil Kamath and Gruhas, the investment firm co-founded by Kamath and Abhijit Pai. This investment will empower Primus's mission to develop India's first full-stack solution for senior care, revolutionizing how elder care services are delivered across the country. To tell us how, joining me now is Primus's founder and MD, Adarsh Narahari. Adarsh, welcome to Startup Street. You specialize in the development and operation of senior living communities. If you could elaborate on the business model, the pain point that you're solving, and how your offerings unique, what is Primus's integrated care for senior living all about?
Hey, thank you guys. Thank you for having me on your show. So essentially, what we are trying to do is we're trying to reduce the process of aging, right? So if you look at why people get older faster, there are typically 4 or 5 factors to that, right? There's health, which is the most obvious one, but there's also a huge psychosocial aspect, right? And if you look at what a blue zone does, and for those of you who don't know what a blue zone is, it's an area or community in the world where people live the longest, right? The average age is closer to 100. These are Okinawa in Japan, Loma Linda in California, Sardinia in Italy, and there are such 6 blue zones. So there is a commonality, between all of these blue zones. And the commonality is that people are physically active, they are mentally active, they have a strong sense of community, they eat the right food, and they have a strong sense of purpose, right? So essentially what we are doing as Primus is we are trying to create these mini blue zones in our projects where we're able to, help each of our elders rekindle purpose, keep them physically active, put them together in a social setting, and make sure that they're physically and mentally active.
Yes.
Along with that, we also have something what we call proactive healthcare, right? We try to find things before they go wrong.
Okay.
Think of physiotherapy instead of a knee replacement surgery. Think of catching through testing if you could catch cancer in stage 1. So essentially what we're doing is we're keeping people alive on their feet and happy long, as opposed to being like a hospital, which kind of
Okay.
surgeries and, delay mentality. So,
All right. Adarsh, if you could take us through your fund allocation plans as well, how do you plan to use the $20 million raised?
So we'll be using it in a combination of both creating intergenerational housing communities. So we have pioneered this concept of having elders as part of larger communities so that they get to interact with every age group, and also staying together with families in Indian emotion. So we are providing a conduit for that. Another part of the fund will be used towards creating a technology platform. So essentially, whatever we have been providing within our community for various services, we are now going to take it to elders in their own home, right? So essentially, it will be used for a combination of both of these.
Okay, and you also plan to deliver 3,500 homes across 6 cities in India. Where are you currently at, and what is the timeline? By when do you hope to achieve that?
So we're already operating close to 500 homes. We are in the process of building and delivering about 2,000 homes. So I think we're on track within the next 5 years to be closer to 5,000 homes.
Right, okay. You know, Adarsh, you say you're redefining elder care through your personalized solutions. If you could take us through your tech edge, how are you catering to the unique needs of seniors, like you were mentioning, you know, through your technology, their safety aspect, health at the same time, and fostering a sense of belonging and purpose?
Right. So, you know, in India, we always get confused between relevance and reverence. We have all been conditioned that we have to respect our elders, but we have never been taught that what our elders want is to be independent, to seek, to be, to have a high sense of agency. That's what we're empowering, right? Our technology solution essentially makes it simple at the front end for the elder to make any request. These requests will be primarily around engagement, lifestyle, travel, health. It could be just about anything, right?
Sure.
And then at the back end, we'll have some form of sophisticated technology that ensures that we deliver consistent and high quality services.
Okay. So tell us, how much will Primus's homes cost, Adarsh? You know, who can afford this, and what is the revenue model? How do you also plan to make money?
Right. So typically a home works like a real estate as far as the home is concerned. So it would start at close to 70, 80 lakhs and go on to a couple of crores, depending on how big the home is. And then we layer in the various services that people pay for monthly. So on an average, a person would pay around 30,000 rupees per couple per month. And that would mimic what a typical upper middle class Indian elder would spend in their own house, but with the assured convenience of getting everything for sure. So that's how we are typically priced.
All
and
right.
we both on the services as well as on the selling of the home.
Okay, all right. One final question, Adarsh, before I let you go. India is getting older, and with the rise of nuclear families, we need to rethink how we take care of our elderly. So clearly, there is a lot of business potential. So if you could take us through your future expansion plans, the revenue targets that you've set for yourself.
So what the government doesn't tell you is that by 2041, the elder is going to be the largest cohort of the Indian population. So naturally, that opens up a large opportunity for anybody looking to solve in this space. For me personally, I'm not targeting a certain top line or a certain bottom line. I think for me, it's about the number of elders that we can impact, right? We are looking to impact close to 1 million elders over the next 5 years. And we're looking at developing over 25,000 homes. So that's kind of what we're looking at.
All right. So we wish you the very best. Keep enriching the lives of our elders. Thank you so much, Adarsh, for joining us today on Startup Street. Wish you the very best.
Thank you. Thank you so much, guys. Have a nice day.
On that note, it is time for us to head into a short break. But coming up next, D2C meat and seafood brand Licious has reported modest growth over the past 2 fiscal years, with revenue stabilizing around 700 crore rupees. We put the startup's founder on the hot seat to decode the firm's financial performance on the other side. Stay tuned.
D2C meat and seafood startup Licious has reported a 44% drop in losses and an 8% decline in revenues for the financial year ending March 24. Now, Licious said the closure of distribution channels
Welcome back to Startup Street. Licious saw a 44% reduction in losses in FY24 despite a 9% revenue decline on a yearly basis. Ritu Singh spoke to the co-founders of Licious on their financial performance earlier last week. Here's a slice of that conversation. Listen in.
D2C meat and seafood startup Licious has reported a 44% drop in losses and an 8% decline in revenues for the financial year ending March 24. Now, Licious said the closure of distribution channels, Dunzo in particular, and the winding down of exposure to modern trade and local stores that dragged their revenues, but they expect to achieve EBITDA break-even in the current financial year as they expand their offline network. Now, Licious has also announced the acquisition of Bengaluru-based offline retailer My Chicken and More, bringing its retail points of sale to 26. For more on this, joining me now are the co-founders of Licious, Abhay Hanjura and Vivek Gupta. Abhay and Vivek, thank you very much for being with us here on CNBC-TV18. And Vivek, let's start with the financials where revenues have declined 8% because of this third-party distribution channels closure. Just tell us what exactly happened here and how much dependence you now have on these third-party channels and whether you see revenue course correcting in FY25.
Yeah, so our revenue on quick commerce and other channel partners is not very high. It is closer to 20% today. Earlier also it was not very high, but there are only 3-4 channel partners, and with Dunzo not able to raise money, obviously that channel has, we have stopped the business a year ago, and that revenue decline we can see. Even Swiggy has pivoted, I think a year and a half ago, from a Swiggy meat store business to Swiggy Instamart, where they have moved the meat business. So that was also a little bit of a readjustment, which we saw in the last financial year. In our own platform, we have actually seen a growth of 5%, but this whole channel partner business little bit got readjusted.
You know, losses have also dropped by 44% in FY24, but they're still quite high at nearly 300 crores. One, what helped you bring down the losses in the year? And two, what gives you confidence that you will achieve EBITDA break-even in this financial year? And after that, how soon do you think you'll be PAT positive?
Okay, so actually that's a last year number. We are actually currently at a burn rate of around 140 crores annually. So that is why in last 6 months we have cut it by 50% more, and eyeing like a very negligible burn by March. So we should be very close there. All this is happening with supply chain efficiencies and cutting all these flaps of unprofitable channels. So I think business that way is on a very right track to achieve profitability in next 6-8 months.
All right, Abhay, quick commerce seems to be the flavor of the season. We're seeing that across the board. Your own quick commerce deliveries have increased by 30% over the previous year in FY24, and you're piloting that 30-minute delivery in Gurgaon at the moment. What exactly is the strategy on that front? How soon do you hope to expand from Gurgaon to other cities? And will this also mean some pressure on profits in the near term?
Well, so let's take it, in the parts that you asked the question. So like Vivek said earlier, quick commerce contributes to about 20% of the total business. And if you go one step deeper, you will see that the most of the demand on quick commerce is driven by what are more staple, SKUs like a chicken curry cut or egg or something like that. So what we are seeing is that, very base staple SKUs which have that instant impulse use case are the use case that consumers are adopting on quick commerce, and that's where we're seeing the growth. On channels like Swiggy or Blinkit, we hold the dominant market share as well. So it's important for us to be where the consumer is, and hence we're working very closely with the partners like Swiggy and Blinkit, who understand that this is a category which needs different attention and appreciation from a cold chain and perishability perspective. So those channels are growing, and of course, in time we are also evolving our own network to become faster and a multi-tiered, multi-promise network, which is where the 30-minute promise is coming through. So Gurgaon is live. In fact, we've seen 40% growth in the areas where we have launched 30-minute delivery, and we hope to complete a total rollout in India over the next 6 to 8 months.
In terms of your offline distribution channel as well, and now you recently announced the acquisition of My Chicken and More, and with that, your retail point of sales have gone from 3 to 26.
In this context, just give us a sense of how many offline stores you're planning, because as we understand, the bulk of your orders are still coming from your own application.
So, and it was, the decision to go offline has been timed with intent, because we were waiting to get to a, large scale, reduced burn, and finally be ready to expand the offline footprint in a meaningful way. Now, with the 26 store addition, our network has expanded, but what we are thinking of is that by the end of the fiscal, we should get to a 40 store sort of a footprint very quickly. And the idea of going there is to get the box right, because in retail, it's extremely important for you to figure out the DPMF within each box, and every market is very different. Ritu, Calcutta will behave very differently from Bangalore, and Delhi and Bombay will behave very differently, given some regions will have greater affinity to fish and seafood, some will have greater affinity to some other category. So it's important to get the box right, the customer experience, the profitability right.
Vivek, if I were to get more specific about this deal with My Chicken and More, one, what was the deal size? You haven't disclosed. How much additional revenue is this acquisition going to bring in? How many new customers are you going to add to your base?
Yeah, so we have obviously not announced the deal contours to media, but it's a 23-store business in Bangalore, which does around 110 crore of annual revenue. The business is profitable. Stores make around 8-9% EBITDA, and at company level, the company delivers 4% EBITDA. They do 16 to 18 lakh orders per year. So we will fund their operations also to grow faster. Okay, we have not yet figured out more depth of operational, but there are a lot of synergies in both the companies in the back end.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.